is nearly October. We're thinking about the end of the year. And so if you're a certified financial planner like Jeremiah and myself, we start thinking about taxes. You might be thinking about preparing your holiday gift list. That is also on our list. But we are also thinking about tax planning and some of the maneuvers. And one of the most powerful impacts you can have on your end of year tax liability is through charitable giving. And so today we're going to talk about some key tax strategies that have to do with charitable giving and the impact they can have on your tax liability. So to dive in, we're gonna focus on a couple of different topics, but specifically donor advised funds. So to kick us off, let's talk a little bit about why in general charitable giving kind of becomes sort of a win-win for our
Yeah.
clients.
Well, this is some of my favorite topics, not just of giving, but I think people, when they consider giving generally, when we first meet them, they think of it as just like a leak. Oh, it just goes away and I do something good, whether they're very committed to that and they're giving a lot of money or just a small amount. But that's all they consider is the good they're doing. But man, there's some really powerful tax strategies of how you give. And for clients of ours who are not interested in giving, we don't talk about these and we kind of move forward. But I'd say the vast majority of our clients, they already are giving to some charities, some community events, some churches, some or different organizations already. And these two things we're going to talk about today, man, it is a really fast upgrade to what they're doing. Save some taxes, save some kind of some future gain, but also it just gives a different perspective on what they should be doing with their giving each year. And I think
Right.
it supercharges how they're giving, but also gives them the freedom to give the ways that they want to give.
Right. We actually, as a married couple, for the listeners, Jeremy and I are married, and we've actually spent some time more recently, like in this last year, and about once a year, we sit down and we kind of refresh our charitable giving strategy. And so we talk about things that are most important to us and actually have developed kind of tiers to our giving strategy. And maybe we'll talk in more detail on another episode. But it's really a win win because not only are we recognizing the tax efficiency, which is something that we'll focus on in today's podcast, but you're talking about ways that you can impact the matters that are most important to you, issues that are going on in your community, and for those who are interested in leaving a legacy as well of giving. And so there's a lot of different aspects to it. Now, disclaimer, we have several clients who are very generous and who like to give, but it might not be to federally registered charitable organizations. It might be that they're very generous with family members, or they're very generous with giving private loans to friends. There are other ways to be generous, but what we're going to talk about today is the tax benefit that you can receive from giving to 501c3s, 501c6, different federally registered tax entities. That's always a tongue twister for me. I don't know why.
It's good. It's good. Well, let's jump in. So the first one, I would say this blows a lot of people's minds. And it's just one of the ways that people should, in my mind, should be giving, if at all possible, is donating appreciated stock. And we'll unpack what that is. But say someone's going to give some money. They want to donate $5,000 to some cause. They have a few options how to do that. One is they just pull out their checkbook and they write a check. Or they go online, they process through a credit card. That's kind of giving your cash. Not a bad way to do it. That gets it processed. But you think about what you're giving, the cash you're giving, you've already paid taxes on that money. Whether it was earnings that you received from your job or some stock you had that grew and then you sold it. Well, the upgrade here, the real quick upgrade, is instead of giving that $5,000 out of your checkbook, is to go and look at your portfolio, your stock portfolio. This would be your taxable investments. So things like that's in a trust for you or things that's in an investment account. And look in there and say, is there any stocks that I have that have capital gains built in them? Something you maybe bought 2 or 3 years ago. And anybody
Or
looking at
20 years ago. Let's talk about if you bought Apple 20 years ago, right? And the amount of growth that you have. So what you purchased it for is your cost basis. So for the sake of illustration, let's say you bought Apple for $50 a share.
Great.
Then what happens?
And then, right, we pick it up. So as you look at it, anyone in 2025, you very likely have capital gains this year. It's been a great year, 2023, 2024, and 2025. So I think there's a lot of people out there sitting on appreciated stock. And if you were to sell that stock, using Laura's example, you bought Apple for $50 years ago. We're just going to pretend that today it's worth $500. So it's grown a lot. You've had this for a lot of years. If you were to sell that stock in order to get the money that you needed to make the donation, you would have to pay the capital gains tax on the difference between what you bought it for and what you sell it for. And in this example, if you bought it for $50 and you sell it for $500, that $450 difference is capital gains. It'll be taxed at 15% generally for most people's tax brackets. So as you pay that taxes, you have a little bit of leakage, to the government for taxes, and then whatever's left over, you're able to donate. So the quick upgrade is don't sell the stock. Simply donate 1 or 2 shares of Apple, whatever you're interested in donating. Donate it directly to the organization, the church, the charity, whatever it may be. Donate it directly to them. They're able to receive it. So the benefit here is because you're donating the property, you get the full write off. You get the $500 a share write off is what goes on your taxes. Now, the charitable organization, they receive it into their brokerage account. Most of them liquidate it. They go ahead and sell it. And so now because you gifted them that stock, they also are gifted your cost basis. So now they have that low cost basis, and when they sell it, they have to pay all those taxes. But because they're a 501c3 or some sort of a charity, they are not taxable.
Non-taxable entity. So it's a way of alleviating your tax burden without passing it on to the charitable entity. So this is just one way to give instead of giving cash, which are after tax dollars. Go ahead and give your appreciated stock to a charitable entity. And it's oftentimes that this just doesn't occur to a lot of our clients. It's not that maybe they're not aware of it, but it's just not something that they think about. So as we're coming into the year end, you might be attending a fundraising event, there might be a call to action, and just instead of pulling out your checkbook, just ask, do you accept appreciated stock? And if they do, then you get together or you look at your account and say, which holdings should I donate?
Yep. And for this is a normal analysis that we do with a lot of our clients. They say, hey, I'm planning to do some giving year end. I want to give X amount of dollars. So then we would look at their holdings and say, what's your most appreciated stock? Like basically, which one has the most built in taxes? Let's offload those. And it's the other helpful piece of this is it helps kind of turn over your stock portfolio. There's certain holdings that you've had for a number of years that were great holdings, but maybe you're not certain you want to keep holding them any longer, but you don't want to transition them and sell them because of the tax impacts. So this is a great way to start chipping away at some of those highly appreciated stocks and allowing you, as a lot of our clients, they'll donate the stock and they'll put their cash back into that same account to keep their investments at the same level. And so they're kind of rotating into new assets periodically.
Mhm.
So it's a great upgrade, something that our clients do every year. And so I would encourage anybody, if you're, just as Laura said, if you're thinking about giving, take a look at your portfolio and think, is there anything in here that I'd like to give? And the beautiful thing about stocks, as opposed to say real estate in this situation, if you're going to gift stocks, you can just gift 1 share or 2 shares, which is usually a very reasonable amount. If you had real estate that had appreciated, there's also some benefits there, but you have to gift the entire property. And that is not helpful for a lot of people. They're
Mhm.
not looking to give a gift quite that large until end of life.
Or of
So
course,
that's
you'd have to sell it and then give a portion of the proceeds, and that would still be taxable. So
taxable.
anyway, so that's one strategy, is the donation of appreciated stock. Let's talk about, we oftentimes work with business owners or entrepreneurs, and they have a high income year, whether it's because they're selling a company or they've had, exponential growth with a new business opportunity, et cetera. But let's say all of a sudden you anticipate or experience a very high income year in comparison to your other years. This is where we get to talk about lots of different strategies, but one for today's topic is to do with your charitable giving and kind of a bunched giving strategy, which a lot of times people have heard of that kind of bunched giving strategy. But what we often recommend is opening a donor advised fund. There's a lot of different custodians that do this. We oftentimes work with Charles Schwab. They have they call it a Schwab charitable account, right? We've worked with others as well. The donor advised fund essentially offers the individual the opportunity to make a larger charitable deduction in the year of high income without having to give all those funds in the same year to recognize that tax deduction. And it is kind of a bunched giving strategy. But there's some additional benefits to opening a donor advised fund. And I'll just touch on a couple. I know Jeremiah has some as well, but you can, like he was saying, in terms of appreciated stock, is you can take some appreciated assets in your brokerage account and actually transfer those into a donor advised fund. Or you can transfer in cash and other assets, and you can let those holdings continue to grow. So your donor advised fund can still be invested, right? The important point to know is whatever assets you transfer into a donor advised fund, in order to get the full tax deduction, they are irrevocable. That means you cannot claw them back. There's no, oops, I'd like to go ahead and take my $20,000 back, right? In order to get that full tax deduction, they're irrevocable. So whatever assets you do transfer into a donor advised fund, they have to stay there. Then you get the full tax deduction in that year.
So
But there's
so
a lot of,
powerful.
yeah,
Yeah, it's such a powerful process because it decouples kind of the timing of when you get the tax deduction and when you actually give the money to a charity. I've had a lot of business owners who sell their business, and in that year they say, "Wow, I'm going to get hammered in taxes. What can we do?" So we talk about giving these larger gifts, but for them, they're not looking to just make a large gift. They're thinking, "Hey, what would I naturally be giving over the next, say, 10 years, anyways? I like to give to charities and different organizations. So over the next 10 years." I plan to give a certain amount of money. So we would actually accelerate all that 10 years of giving into this year when they can take this large write off, put the money in a donor advised fund. And then over the next 10 years, I'll use the word liberate, they liberate the money out of that fund to the charities. The charity doesn't know a difference. It seems it's the same flow of payments, but the individual, they got 10 years worth of write-offs all accelerate into that 1 year, which is, it's just phenomenal. And it's interesting when we use the word give, and I sometimes use liberator, trying to get clear. Like when you put the money into the donor advised fund, like Laura said, it's irrevocable, the money goes in. It can sit in that fund, it stays invested, it keeps growing. But at some point, it moves from the fund to the charity. And we'll call that, liberating it out of the fund. And in that moment, that's when the charity gets to receive it. So you get the write off when you put the money into the fund. So it's a great kind of end of year planning to just move money into the donor advised fund, knowing it's charitably designated. But then you get to control going forward when the money actually gets to the charities. And there's been
right.
conversation of, is this a negative? Like, is this slowing down money getting to charities? And people out there who are familiar in this space, they know that there's foundations exist, like a private foundation where a wealthy family can create their own foundation. Foundations have a rule that you have to give out at least 5% of whatever's in the foundation every year. That's a normal tax rule to make sure the money is flowing out and not just being pent up. Well, the concern was that the donor advised funds, which do not have a mandatory
Giving
distribution
requirement.
amount,
Yeah.
there was a concern that the money would just sit there. But as statistics have shown in the last few years, the average giving out of a donor advised fund is about 20% of what's in there. So people that are creating these funds, they're using them. They're pushing the money out. And there's been a lot of people who are against the idea of putting a 5% minimum on the donor advised funds just for the sake of the expectation that once that becomes the rule and the law, that's what everyone will start doing. They'll
Hmm.
actually bring the amount of giving actually down. Because
And
people who
not
are
to
making,
mention, foundations are more complex. They have more administration. They can have more costs. So it's not to say that for some of our clients, setting up something like a foundation isn't the right way to go. But for many of our clients, a donor advised fund offers more control. And this is one of the things that I was going to touch on is that those funds don't have to be given in a specific name or title. You actually get to choose. And so we have many clients that prefer to be anonymous, or they prefer to come up with some kind of faux name, ABC giving account, right? You can name it whatever you like. And then as you choose to make those donations, you can also do so anonymously. I think I use the word autonomously, anonymously. So it doesn't have to be known, it can be private. You can, on the opposite side, if you'd like it to be known, you can also do things like add in a letter, a reason why you're giving, etc. One of my favorite parts, though, of a donor advised fund is the legacy that you're creating because it has a beneficiary. And so, if after your lifetime there are still funds in your donor advised fund, those transfer on to your beneficiary, still marked for charitable purposes. And they then get to decide where and how they give those funds. So, I love that idea of creating a legacy in terms of your overall family impact of giving.
yep. Yeah, I like that as well. That it allows the kids to take on this responsibility, almost as stewardship, to say that mom and dad were giving, they left this fund. We now are responsible to give this and do good in the world. So then we start getting the more complex. I say the interesting part is how do you combine these types of things? So Laura mentioned a little bit earlier of if you had a donor advised fund, a really powerful strategy is at the end of a year like this year to look at your stock portfolio and say which stocks have really grown. Let's move some of those into my donor advised fund. You instantly get the write off, and then you're able to kind of move forward. So it's a really powerful way to use a appreciate stock and the donor advised fund together to kind of upgrade your giving.
Yeah, and there's no minimums too to the donor advised fund. So we're using the illustration of a high income earning year. It could be just another year where your tax liability is higher than you expect. And so just back of the napkin calculations are about 50% of the value of the funds that you or the assets that you transfer into a donor advised fund will come back to you in terms of a tax benefit or a tax deduction. So let's say that at the end of the year you've got a higher tax bill, you're a little bit surprised, you can look at charitable giving as an option to reduce that tax liability.
The other fun way to planning, combining things, you combine the donate appreciated stock, you put that into a donor advised fund. We have a number of clients then that talk about doing a Roth conversion in that same year. Now we're getting a little more
Ooh,
complex, but
now you're getting fancy.
yeah, that's right. But it all works together to say, hey, I'm going to do some Roth conversion. I want to transition these funds from traditional retirement into Roth retirement. Go ahead and pay my taxes now on purpose, knowing they can grow tax free into the future. But in doing that, wow, that's a bigger tax bill than I want this year. It feels a little painful. Well, we might also couple that with saying, how much of a donor advised fund do you want to build up over the next few years? What are you planning to give for the rest of your life? Let's backdate that to here and start making some of those changes. So we have a few clients every year. We do a Roth conversion, we do a donor advised fund contribution, we do it with their appreciated stock, and it's really moving them forward to a position they want to be in. So that's, when you start combining some of these items, that's where they really get powerful. Now, one, I'll take a little detour. Qualified charitable distributions.
You read my mind. That's what I was going to talk about
Great.
next.
We're connected. I love it. Some folks are giving qualified charitable distributions directly from their retirement account to a charity. That they, instead of receiving their required minimum distribution, they send it to a charity on purpose. And in doing that, they basically allow that money to skip over their taxes, doesn't impact their AGI for IRMA purposes. There's a number of different tax thresholds.
Right.
But the issue with that is a qualified charitable distribution and a donor advised fund are not friends. Unfortunately, they don't work together. And so that's one where we've had a few clients get very excited about this and say, well, I do some of my giving out of this. Can we just swoop that in? Those are two separate strategies. They can work side by side, but you can't
Hmm.
send your qualified charitable distribution into your donor
Yeah,
advised
or
fund.
QCD as we often call them. And this often comes into play for our clients who are not reliant on the cash flow from their required minimum distribution. So at that point in the future, when you are required to start taking income, rather distributions from your retirement account. So you've been able to put away those funds tax deferred, they've grown over time, and now you're forced to start bringing that income into your home. And for IRMA or for different reasons, right, you might be sensitive to not wanting to have that income recognized at the end of the year. And so one of the options that you would have, especially for RMDs, is oftentimes when we talk to our clients about setting up a QCD. So that would have to go directly to the charity. It can't be reinvested in the donor advised fund. But like Jeremiah was saying, the two strategies could work side by side. There are other ways to be creative about giving, and the amount that you can write off on your tax return based on the type of asset that you're giving varies. Right. So if you have any questions about, well, what if I gave this artwork? It's a collector's item. I know what the value is. What if I gave that artwork to a charity? Right. There's still a tax write off, but it's not necessarily the full value of that asset. So these are great questions to bring to your CPA or your financial advisor when you're thinking about creative ways to give to charities.
Yeah. And what we love to do is not just the one off, can I give this, but rather to say over the next 5 years, over the next 6 years, what are we planning to accomplish? Do we want to build up a donor advised fund? Do we want to unload certain assets for charity? Had some clients, we had one specifically that was excited to make a large donation at the age of 85. They said, once I get to age 85, I'm pretty confident of how much money I'll need for the rest of my life. And so at that point, I want to give as much as I can away. And that became their goal. It was a reason for building along the way so they could make an endowment sized gift when they were 85. Everyone has different goals. And I think what we love is to see what the goals are, what the vision is for a family, for a household, and then start bringing in some of these different opportunities and strategies to accomplish that. And charitable giving, this is one, like Laura said at the beginning, we think about this time of year. As we're getting ready for holidays, the weather starts changing. We want to think about, okay, where are we in this charitable giving plan, this 5-year plan, this 10-year plan, and what do we want to do this year? For some clients, it's the first time we've had this conversation. For many of our clients, we've had this conversation every year, and they're excited to say, oh yeah, we did this much last year, we did this year. I felt the tax benefit of that. I understand how this is going to benefit me in the future. And then we kind of keep doing that year over year.
Because we like to take it beyond just talking about taxes. Oftentimes the first question on our client's mind is, will I have enough? right? Do I have enough money to make sure that I'm going to cover all of my needs? And once all of those questions are answered and you have a degree of confidence that what you've earned and what you have in your bank accounts and all your net worth combined will provide for your basic needs and your family's basic needs, then we get to start also talking about what is the opportunity and further, what's the responsibility that you might have as you accumulate wealth, right? At the end of life, what does having millions of dollars left over in a bank account do for you? What is the legacy that you want to leave? And that benefit that you or a potential client has experienced is an opportunity, right? To really bless an organization, to bless your community. It can have a great impact. And that takes time to discover what it is that's most important to you. And I think those are important conversations, and we're here for it. I love being able to sit and even brainstorm and consider. And again, the benefit of setting up something like a donor advised fund is that you can go ahead and decouple, like you said, the tax deduction from the time at which you give and the organization to which you give. So it doesn't always have to be the same. You don't have to predetermine which organization you give to. You just mark those funds for charitable purposes. And then over time, your charitable giving strategy will develop and probably change. And, you might get more connected with a certain organization, right? Et cetera, et cetera. So those are really fun, creative conversations that we get to have with our
Yeah.
clients.
And everybody's different. Like Laura said it earlier, like, some people are really excited about this conversation, others aren't. And that's okay on both sides. But when this is a piece of their life, when this is a piece of their story, it's wonderful to be able to give an upgrade, not just giving from your checkbook. We're all about to enter into this, I don't want to call it fundraising season, but, charity dinners, charity events, those usually happen in October, November, December, silent auctions, things like that. If someone who has all this set up, they are already armed to know, hey, this is how I'm going to give the money. This is the amount I want to contribute to certain organizations, versus being sitting in an event and nudging your spouse. Can we give this much? Do you want to do this much? Like, really being strategic about what you're doing, be on the same page. We find it gives a lot of freedom to folks as they go into the holiday seasons, wanting to be generous, but now having the ability to do so strategically.
Yep, absolutely. Well, to all of our listeners, thanks for participating today. We hope this was helpful. We have a few more things to let you know about before we go. Podcast reviews really help us to serve more people and get this information into the hands of the people who need it. Please leave us a review. Even if it's not 5 stars, we welcome the feedback.
And we invite you to let us know what topics you would like to hear more about, or what would benefit the people in your life who you're closest to. We have more resources online. Those resources are designed to help you share this great information easily with people in your life. To access those resources, please visit tricordadvisors.com.
Often we hear from clients that they wish they had talked to us sooner. If that's you, we'd be thrilled to see how financial planning can benefit your life. Email us at contact@tricordadvisors.com or simply click on the link in the show notes.
This show was produced by Graham Gardner at Model FA. Find out more about how to create a podcast for your financial planning business by visiting modelfa.com. We love creating content that's useful, resourceful, and maybe even a little entertaining. We want to make this mega universe of financial topics and advice applicable and helpful to your life.
Remember, at Tricord Advisors, we are your future's best ally.